All right, good evening, folks. It's Tim Davis coming to you guys with my midweek market review. And today is Wednesday, April the 26th, 2023. The time is now about 9:46 p.m. I want to start out by taking a look at the VIX. I want to point out to you folks what I've been pointing out for a while now is that the VIX was definitely in this shaded area. The VIX, this is a shaded area that the VIX has been bouncing from for well over almost 2 years now. And anytime we get to the extreme bottom level of that range, we normally start to see some type of significant reversal in the VIX. And it looks like that has started to materialize. Look at the rounded bottom that we formed as we were pretty much basing, or pretty much basing, setting a stage for a potential bounce. We were basing at the bottom of this range, finding support. Looks like we're starting to move up. And if we look at the blew this up so we can see the totality of circumstances, looking at what's transpired over the past couple of years with the VIX, since we've been in this bear market, and every time we got to extreme levels, we've eventually seen continuation of an extreme rally to the upside in the VIX. Still, it's not going to be enough. I don't think it's going to be a straight line up, but I think we'll see the VIX in general start to march its way up over the next couple of weeks, maybe the next couple of months. The last time we seen this type of pattern here that we're seeing now, we experienced it back here in the beginning of 2022, and we experienced it right around when we first started going up back in the end of 2021. Okay, I highlight these areas because we've seen the VIX sell off, a deep sell off, and then all of a sudden we get a pop back above the 20 per moving average, which is what this light blue line is. You see, light blue line is my 20% per moving average. And every time we have had deep sell-offs in the VIX, we would pop up above this level, pull back to the 20 per moving average, which starts to act as a level of support, and then we see a higher move. Same thing happened right here, the end of 2021, beginning of 2022, all the way down to the bottom of the zone. A big rally back up, back down to the range bound area, or to the top of the 20 per moving average, and then a move higher. Now let's fast forward to see what's happening now. Same scenario, sell off. Now we are back above the 20 per moving average, and we've been above it now for about 2 days straight. So that's normally a positive sign for the VIX, a negative sign for overall markets. Now, with that said, again, nothing moves up in a straight line. So let's zoom in to what this daily chart of the VIX looks like close up. So here's our close-up look, the daily chart of this VIX. And again, see that well-defined bottoming pattern where we started to form a base, found support, and started to march higher. Now look what's happening with the VIX. We are above that 20 per moving average, with some pullback here starting to happen. So look at the full stochastics. We are well out of the oversold territory. Risk percentage out of the oversold territory. So is the CCI out of the oversold territory. There's a wide diversion between the K and the D, or the green line and the yellow line within the full stochastics. Normally see a wide diversion like that. Normally we see some type of reversal. So, but as we head towards the end of this week, today is Wednesday, as we head to Thursday and Friday, it would not surprise me to see a pullback in the VIX. Would not surprise me, but we got to see if they actually materialize, because right now the VIX is showing a strong motion higher. Does materialize, again, I think this 20 per moving average, it's going to find a way to act as an area of support. So any pullback we can see, I don't think we're going back to the bottom of this zone. We could see a slight pullback in the VIX somewhere. And then if we do get that pullback back towards this 20 per moving average, the next bounce is probably going to be a significant bounce, and we start to see it move back up towards 21 or 22 in the VIX. But right now, the bigger picture is that the VIX is now in an upward trending pattern, upward trending motion. So any pullbacks, we'll start to see the VIX create these higher highs and higher lows. I think that's what we are probably going to end up seeing. that is a quick look at the VIX. Now, some other indicators that, you know, the VIX could be going higher, markets could be going lower. Longer term, again, any rallies at this point in the markets, I think it's going to be met with fierce resistance. Let's take a look at the SPXA. The SPXA, for those guys who follow me for a while, you know this is a tool I like to pay attention to give us some possible overall market sentiment. And this tool, it tried to show some life. This tool, if I look at a bigger picture, I'm going to show you guys. Go back in history. So this tool is something that tracks the overall market sentiment. And the highest you can get is 97%. So this pretty much shows you the amount of stocks that are trading in the S&P above their 200-day moving average. And the highest you can get is 100%. We got as high as almost 97% back in April of 2021. Since then, we pulled back, found some support right around here. It's around about said around about July of 2022. Kind of move up, came back down to that same level to create a double bottom back in October 2022. And we know what happened since then. Market started to rally. Now, did not go as high as this 97%. We met an area of resistance up here right around just below 80%, and we started to pull back. That's negative, also a negative sign for the market showing the momentum is shifting back to the downside. This sort of looks like a head and shoulders pattern here too, if you pay close attention. All right, and now with that showing that the sentiment, overall sentiment is starting to lose the steam, look what's happening. It's dying right at that 20-period moving average, and it's starting to head lower. That's negative for the market, so that the overall sentiment of the market is switching. And we are now below, we close at a level below the 50%. So that means less than 50% of stocks are now trading above that 200-day moving average. So now we close at only 46%. So that means there's more stocks closing below that 200-day moving average than they are advancing. All right, now, before we move on to the indices, I want to draw your attention to another tool that I like to use. You can, if you guys are not friends with me on Twitter, this is one that I posted and pinned this to the top of my Twitter feed, how you can get to this tool, which is WSJ.com, which is a link to the new 52-week highs and lows in the NASDAQ and the New York Stock Exchange. So I'll click on this link within my Twitter feed, and it takes you straight to the page that I like to take a look at. Now, what this shows us is, this is the New York Stock Exchange tab that we're on now. This is the NASDAQ tab right there. We're going to take a look at the New York Stock Exchange tab first, and it shows us pretty much the highs at the close of business today. It shows you the new 52-week highs. Now, and it also shows you new 52-week lows. We're going to show those. So right now it shows the new 52-week highs for the New York Stock Exchange. It's only 31, showing 31 new 52-week highs today. And let's scroll down and we'll get a chance to look at the new 52-week lows to see what overall market sentiment is showing us. So look at that, new 52-week lows, 101. So there's more new lows being created than new highs. That's also a bearish signal for the overall markets. More new lows being created than new highs. That is not positive for the bulls, negative for the bulls, and positive for the bears. So take a look at the NASDAQ. Even with all that, you know, good upbeat we hear from some of these tech stocks over the past day or so. Look at the new 52-week highs. 56 on the NASDAQ for the close of business on April the 26th. And then I'll scroll down, take a look at the new 52-week lows. This is a bigger and more astonishing number. 410, folks. If that is not enough to show you that the overall sentiment is not in favor of the bulls, I don't know what else it is. 410 new lows versus 56 new highs. that is a big, very huge lopsided look at the new 52-week lows versus the new 52-week highs within the NASDAQ. Straight bearish sentiment. So that leads me to believe that there is, this bear sentiment is starting to clamp onto these markets again and send its prices lower. So now, with that said, let's start to look at some of the major indexes by looking at the S&P first, SPX. Here's a daily chart of S&P. Now, I want to highlight this. I told you guys that we were trading around the top of this range for a minute, and it looks like we were trading around the top of this range for a minute. It's like we're starting to pull away from the top of that range now. Now we're starting to pull away. So now what we're looking to see is that the 20 moving average is this blue line again. It will start to act as a level of resistance more than likely. So once we show signs of oversoldness, which is what we're starting to see now within the wins percentage and the CCI, it's dipping below that lower line. So eventually, we're probably going to see on this daily chart some type of bounce. When we start to see these oversold levels, but I think the 20 moving average will continue to start to go in favor of price action. So we'll start to probably see this curl down. So any rally that we see now, it's probably going to run into that 20 moving average, and it's going to act as a level of resistance. And then if we run into that 20 period, we can see a move up, and then a move back down to start to create lower lows. Sort of like what happened here. Seeing price action drop below that 20 moving average. Got a little bounce here, but then just came right back down. Same thing happened around the end of February. Got a little bounce and came right back down to the bottom of the zone. That's what the S&P daily chart looks like. Let's switch straight to the Dow Jones. Dow Jones, same type of scenario, folks. We're starting to head lower, starting to drop below the 20 moving average. Price right now is showing full stochastic wins percentage, and CCI starting to hit some oversold levels. So we could see a little more drop on tomorrow, but by Friday we could see a bounce. That will more than likely be stopped by the 20 moving average. So that's something to pay close attention to as we head to the rest of this trading week. Let's take a look at the NASDAQ, which has been trying to show some strength here this week because of some of the positive earnings reports from our some of these tech stocks. But it too has still been struggling, as you can see here with the red candles that's popping up. So even though we had some positive news for some of these tech stocks, price action is still below its 20 moving average. Like it's like a hangman, like it's just hanging there. With a hinge up in the oscillators within the wins percentage, signaling a possible move higher. Hinge up in CCI, we're signaling a possible move higher. So we could see a little rally here with the next day or so, especially with after Meta reported good earnings at today after the closing bell. So that could help boost the NASDAQ up a little bit, but I don't think we're going to see a major rally. I don't think we're going to start trading back up here around these levels. I think we're going to see a little rally back up to 20 moving average and possibly reverse. So there's something to pay close attention to, that we could see a little rally, but I think the 20 moving average now is going to be in control of price action on the daily chart. That's what our NASDAQ looks like. Now, I want to draw your attention to the Russell, because in order for the overall markets to get out of this bear market, and for folks to believe that we're out of this bear market, is that we need to see the Russell participate in a major way. And the Russell is getting very, very close, extremely close to breaching this dashed line I have down here, which represents the highs of 2020, folks. The Russell is getting very, very close. Russell is now heading back lower. It's getting very close to First of all, touching the lows that we saw back in March. Russell was down, fell below its 20-period moving average. So that 20-period moving average is more than likely going to act as a level of resistance, as it did here, And we see every time we hit that 20-period moving average back at the beginning of this year, Russell, we have found a way to pull back in a major way. So do we get a rally here soon? And then a huge rejection below where we stopped at this week? That is a huge possibility, folks. And if that happens, if we get a rally and then an immediate pullback to take out these lows, let me show you guys something. Let me show you how it looks on the bigger picture, how close we are to breaking below the highs of 2020. We are extremely close. And if that happens anytime soon, we're going to really start to see the sellers really pick up across the board and start to really show some deep selling in this market. Let me show you guys what a 5-year weekly chart looks like. Here we are. So look at the weekly chart. Look at what's starting to unfold. Look at the oscillators and the wins percentage, folks. It's starting to dig lower already. It's remaining lower, and it's like it's ready to come oversold. Look at the forceful casks, like it's ready to start to dig lower. Look at the CTI, like it's ready to start to dig lower. And look where price action is now according to the weekly chart. We have bounced from this level multiple times on the weekly chart over the past year. And we have not created any major new highs. We've been in this tight range on this Russell on the weekly chart for over a year now. The question is, are we about to break the bottom of this range on the weekly chart? If I was a betting man, I would say it is very, very close to happening. And it's like even on the weekly chart, that 20-period moving average is starting to act as a strong level of resistance, not allowing price to break back above it, as you can see here. Not allowing price to break back above it. Folks, if we break this line here, that is going to put us in this range that we were in 2020. So that will have us breaking below the 2020 highs, and we will start to retreat back below the 20-period moving average and start to head to the lows of 2020. So that's what I've been keeping my eye on, folks, in a big way, because we could be in a process of about to see a major downturn in the overall market. So, and I think that Russell is going to be the leading indicator. The Russell and the VIX is going to be the leading indicator. So I do expect something to unfold over the next couple of weeks on this weekly chart. We got to pay close attention. If we start to break below this level, we're going to start to see some fear selling in our overall markets. I wanted to point that out. Pay close attention to the Russell. Pay close attention. Keep your eye on the VIX. Here's a weekly chart of the VIX. Look at that weekly chart of the VIX, folks. Like it's ready to fire off. So these next couple weeks, if we get this VIX above that 20-period moving average on a weekly, and look at the oscillators and the forceful casks on the weekly chart of the VIX, it's ready to fire off and come out of oversold territory. So these next 2 weeks, I think, is going to be crucial. These next 2 weeks, watch to pay close attention to the VIX and the Russell. You see this VIX close above this 20-period moving average between this week or next week, or we have to on this weekly chart, we're going to see a major shift in overall markets. All right. So that is what I have for you guys. One more thing. So for those paying attention to gold and silver, okay, gold and silver too it looks like it really wants to defy the odds and find a way to head higher. But right now, it's stuck above the 20-period moving average on the weekly. Doesn't pull back any further. We have to wait and see. But it is holding steady above this 20-period moving average, even on the weekly chart. Silver is, let's see, doing the same, staying above the 20-period moving average on the weekly chart. So could we go higher? We could. could go much higher. And I do think in the future that will happen. Look at the current daily chart. It looks like we are hovering right at that 20-period moving average right now as we speak. So are we going to hold that level? We have to see what happens as we head towards the end of this week. If we do, we could get a strong bounce on the 20-period moving average. If we don't fall, if we fall below it, then I do think we'll find support somewhere. I do think for the longer term, I think the silver and gold is definitely going to continue to be a place to be. All right. All right, folks. Hopefully this helps out you longer term traders who are looking at the bigger picture versus just day-to-day action and the day trade and stuff. But hopefully this is something that everybody can use. But until the next video, Tim Davis is signing off. Enjoy the rest of your evening.